weekly chart, which goes back to around 2010. It broke kind of technical levels it hadn't seen in a decade. And the reason Aussie yen and other yen crosses crashed so hard is not because of the news, but because of the market conditions when the news was released. So, number one, it was a Japanese bank holiday. Number two, it was the period of time between New York and Asia sessions. So, a time when liquidity is super thin anyway. And what happened is a cluster of massive stops got triggered. Okay, stops which usually wouldn't have been an issue, but in this case, because there were no buy limits there to stop price from tanking. Okay, because liquidity was thin, we got this massive move, and this is a move which has nothing to do with value. It's what you might call a kind of technical event. It's simply the result of the kind of behavior I'm trying to describe. Okay, and then of course, the entire move is retraced because that move just doesn't represent fair value. It's not reflective of where Aussie yen kind of should be trading, right? It's simply an artifact of market mechanics. And it's these kind of anomalies which you want to look to trade, and which I think it's really important to kind of structure your trading around. And they're not always so extreme, but this is just an example of the kind of dynamic which happens day in, day out on all time frames. And for me, this is where the edge is, because what happens after is predictable. Okay, price has overshot itself as a result of purely technical factors, and as a result, you kind of know what's going to happen. What happens after is predictable. Okay, we have an edge. Price shouldn't be down there because prices move down so quickly. There's a liquidity void in there which sellers aren't in a hurry to fill, of course, because these are bad prices, and so price draws up. Is that clear? Okay, good. Because it's I think it's not understanding this which is part of the reason why traders get themselves into so much trouble. Because you might have noticed that the market has a kind of illusory quality such that when price starts running like that, people think that it's going to run on forever. And, when it starts dropping, they think or feel like it's going to drop in a straight line without any pullbacks. But in fact, as a result of the kind of order flow dynamics I've been trying to describe to you, this is Bitcoin. When price appears most bullish, it's actually most likely to start dropping. And not as a result of a level, but as a result of the way in which price comes into the level. Okay, that's illiquid. And if you don't understand this, then you're fucked, basically, because the way in which price moves is everything. So apologies if I've kind of hammered on about this for a bit too long today, or if I've repeated myself, but I think that understanding this dynamic can go a really long way in helping you overcome some of the more common psychological pitfalls in trading, like buying tops or failing to take profit at reasonable levels. And it's this understanding and the internalization of this understanding which will give you the confidence to enter at good prices at the level, rather than waiting for quote unquote confirmation before you get in. Okay, at which point, of course, the move you wanted has probably already happened.